Welcome to episode 22 of the New Barbarians podcast. Sorry for the delay. We had technical difficulties again, but we are now live. Today is Wednesday, June 4th, 2025. The podcast will hit the platforms later today, but it will be on YouTube immediately since we are live. In our last podcast, we talked to Lisa Huff and Dan Morrison about the growing intersection of AI, Bitcoin, and energy. Highlighting how strategic compute is becoming the new oil and how Bitcoin and AI are serving as base layer infrastructure. Today, we expand the ecosystem discussion to include derivatives, and we believe this is a timely topic as crypto assets are going mainstream with changes in regulations and political regimes, etc. Today's guest is Ben Golub, head of derivatives trading at Secure Digital Assets, a firm connecting institutions to the burgeoning digital asset ecosystem. Ben's deep experience as a derivatives trader in both traditional finance and now digital finance positions him uniquely to discuss how these worlds are merging, which is usually the topic of our podcast here on the New Barbarians. So he's sort of the perfect person to talk to about what's happening in the world today. And with that, I will pass it off to Mark to give us an update on that.
Great, thanks, Bill. Yeah, I liked how you brought the ecosystem back in, because with Dan and Lisa, the feedback I got from people were saying, what, Bitcoin is the trade route of the future? You know, kind of like rolling their eyes. I'm like, yeah, because it allows you to transfer now and we think secure other transactions over time as we build on it. So, and then Dan's explanation about his statistics about the people that know how to rig and reconstruct certain oil rigs and the technology behind it are fewer than the amount of people that know how to build a space shuttle. So I think he was just talking about the constraints of knowledge in the energy space and how, you know, having Bitcoin and AI work together, they can free up some of these bottlenecks, like what Lisa was talking about. But Ben, bringing you in, instead of going to energy and Bitcoin, we're going deep into the vertical of derivatives. So before we start, I'm just going to go into markets. You know, you and I were talking with Bill a little bit ahead of the call here. So I am going to share a screen here and talk slower so that I can make sure that everyone sees what I'm doing. There we go. Okay, so we usually like to start off with the scorecard. And, you know, we show May month to date, year to date, and 1 year. And what we don't show is June. So the first 3 days of June, or 2 days of June, have been in everything but the bonds rally. So the reason Ben's here, and he's still in digital assets, what did we say? It's like dog years, Ben? 1 year is 7 years. I know you did TradFi as well. Is because the traditional markets are wasting away. The margin from trading equities and bonds are almost negligible. You know, Bank of America used to have hundreds of treasury salespeople. Now they have none. They just have machines. And that value proposition has actually flowed right to the asset. Look at this screen here. And the worst performer in May, yes, you guessed it, was the US Treasury ETF, 7 to 10 year. That's with interest, down 1.2%. Over the past 20 years, treasuries have compounded less than 1.5%. That's all in, 1.5%. And there looks like they're continuing that. So for an asset class that is 150 trillion or so, you know, doing corporate credit and sovereign credit, there's a reason why you're seeing a lot of movement here in orange. Bitcoin up 10.5 month to date, up 11.5 year to date, up 52% over the past year, and then gold as well. People are slowly figuring this out. So that's the scorecard. Again, it's, if it was a bingo card, it would be, all chips on gold and Bitcoin yelling it out right now. And that's been the persistence for the past few years. And the reason we see this, we revisit this slide all the time, Ben, like every third. Bill is asking me to stop doing it. But I will when people come back and say, are you serious that we have as much debt to GDP now as we did when we were trying to fight a world war? And the answer is yes. So the question is, who are we fighting and where's the payoff? And that's why Scott Bessent has shifted everything and said, I inherited a 6.7% deficit and we're going to grow our way out of it. And that's political speak for we're going to inflate our way out of it. We're going to let money, right? We're going to let money run, and our real growth is 2%, but the inflation rate is going to be closer to 6 to 8, if not higher. We already know that services and rent are well above CPI, which is 50% of the majority of people's expenses. So the CPI is a lie. But the reason we start with these two graphs is the whole thesis, everything in finance, if you're building a business, looking to build your wealth, answer the question, how does my wealth survive and perform? If the debt issue is not solved, we keep growing it. The impasse will come, I think, in September when we grow again. And how do we reduce the deficit when we only have like 15% discretionary spending or less after interest expense, military, and mandates like healthcare? So hold on, we get to have some good news. And we know people are like open up their window on the 4th floor, ready to go. But there's good news, but not yet. So there's so much debt out there that it's really hard. The reason we try to be simple on this by showing just performance. How has Bitcoin done? It's done well. It continues to do well. Get curious about why. Bonds aren't doing well for 20 years. Maybe get curious. Because if you go into the weeds of this stuff, it gets confusing. And here is a weed I pulled out of the Treasury garden. It's the Treasury General Account, which isn't a very off-cited metric, but it's a checking account. And you're only looking at it from 2019 to 25. Prior to then, it only ran at like 5 or 10 billion. It kind of kicked up in 08, but they didn't use it. But now the Treasury pulls as much capital as it can in because it doesn't know when they're going to need it. This to me is like the VIX of fiscal austerity. When it's high, it means that they're very concerned. And right now, they pulled down 240 billion or so, 230 billion in May alone. I think by like July, it's going to be zero. They're going to have no buffer. And that's why you see Senator, who's the Massachusetts senator that we all love in the digital asset space, Ben? Warren.
Oh,
thanks, Bill.
Warren, yeah.
Bill was quick on that one, right? So
The save there.
Yeah, our savior said, Trump and I agree that we need to increase the debt ceiling. It's like the only thing besides digital assets that Democrats and Republicans agree is that they need to raise the debt ceiling. So that's going to happen when this checking account runs out. I will bet dollars of donuts when this thing hits zero within either side of 15 days, you're going to see that 36.214 cap on debt just go away with a unilateral or a unanimous vote in Congress. And so now this is, again, lost in the sauce. It doesn't really matter. We saw in the Q1 where net exports, and Bill and I talked about this with some of our guests, imports went up, which means that people were spending money and storing inventory ahead of the tariffs. GDP went negative for the first time in a while. It reversed only recently. So now they're catching up and they're actually exporting. Maybe there's some certainty. That's good news. But I'm like, who knows what comes next? So this I don't look at as something to hang my hat on as a persistent, reliable statistic, but it's just information to know. And I think validation that we are that traditional finance is fakatched and / broken. And that's why, Bitcoin first, stablecoin second, and then, on from there in the digital asset space. So that's all I had, guys. I'm going to stop sharing.
Thank you, Mark.
Yeah.
Take us out of the video glitch there. Sorry about that.
So now I think we can jump into it with Ben. And, to start off, Ben, can you just tell us a little bit about yourself? How did you end up where you are? Where did you go to school?
Yeah, sure. So, tiny little correction. I actually didn't spend much time in TradFi apart from my own degenerate trading on Thinkorswim, just playing options on random stuff. But I went to school at Baruch. I studied math and excuse me. The focus was always kind of finance and financial mathematics. I always found that very interesting. So, went deep into probability. Tried my hand at the actuarial science stuff. I passed a couple of the exams and then decided it was way too boring compared to trading crypto. But yeah, I started kind of my professional career around 2018 at a family fund. That's where I kind of picked up all of the good habits that a trader should have. Not necessarily learned them, engraved them, but definitely was exposed to kind of more professional trading for the first time. And that was, kind of some directional spot, perp future
Ben,
strategies.
what were some of those practices or disciplines that you still have on your tool belt that you use today? That you went in that are memorable. You're like, I remember when, Sally or Barney did this and it was awesome.
Yeah, and it's funny because I'll preface it with this, that the same things kind of apply to your institutional trading, whether it's market making, whether it's, yield generation or whatever it is you're trading. And they also apply to what I like to call monkey trading, which is like me at 3 a.m. trading ETH perps, based on a chart. Actually, the same kind of rules apply. And, one of them is have a plan before your trade. You have to have a clear idea of your profit, your take profit. You have to have a clear idea of your stop loss. And the third thing is that was drilled into my head is you have to have some kind of idea of how risky what you're doing right now is, right? And that could be some sort of sophisticated risk measure if you're at, a hedge fund or a real desk, or it could just be a gut feeling of like, all right, I'm going to long here. This is kind of risky, or versus this is a setup I've seen thousands of times before. And to me, this is a low risk trade. So that's one thing that was kind of stuck in my head. And another thing I think we also talked about a little bit before starting was just hit out, just hit out of the trade. I've seen this pattern kind of repeat. Various firms, it seems like over the past few years didn't do the same thing, whether they didn't hit out of some kind of stupid chain of lending and borrowings and DeFis, they didn't just cut their losses and get out, whether it was continued selling of puts on the cascade down from 60K to 20K, the last market drop. The same kind of rules apply that have always kind of applied to trading.
Yep.
So
Live to fight another day.
Live to fight another day.
You talked about Bear Stearns and the chairman of the firm in the old days used to go around and look at a mark on someone's book, and he'd say, "Great, sell 10% or 5%." And if they couldn't sell in the mark, they were fired. The mark wasn't just something that was aspirational. It was, I want to know what our liquidity is now, based on what you're telling me. You're the professional, and he held their feet to the fire. That kind of discipline of crossing bid-ask spreads to ensure the health of your firm is not used that often. I can tell you that, and it should be.
Yeah, and that's also why there's a big difference between back tests and real tests or trading, right? Just huge difference. Your strategy could be fantastic. I don't want to see it. Like, show me real performance for a couple months, and then we'll talk. But yeah, no, I mean, just picking up from where I left off. So jumped around from there to different trade desk, worked on their kind of capital markets, but it was also prop, low delta kind of funding rate strategies, your classic like linear derivatives versus spot strategies. And then from there, I actually went to Celsius and helped manage their CFI portfolio for a bit before the infamous day. And that was actually a great experience for me in terms of my professional trading. And most recently, yeah, I'm at SDM on the OTC options side.
So can you tell us just what is SDM? What are your typical clients asking for? How do you differentiate what you're doing now versus before?
Yeah, so I might get yelled at later by some team members for saying this, but I like to call us a full suite OTC desk. And to me, it's kind of joining the various parts of finance. So we have a spot desk. They do a ton of volume. They, are hooked up to, you could trade API, you could trade on a platform, you could chat trade, block trades, top 40, top 50, all that good stuff. Really good guys, very good access to liquidity. And then we have a lending desk. So that's also run by a gentleman named James Godfrey, who's got, I don't know, 2 decades, 3 decades worth of experience. I mean, he's headed up bond desks at Mizuho, you name it. So a ton of experience there. And we have a derivatives desk. So kind of a full offering to clients, right? And you can come in, it's a one-stop shop. You have dedicated traders, such as myself. So one of the things that I think differentiates us is, while we aren't necessarily the high frequency streaming market maker, we're a very experienced firm with very tight risk. So no blowups over the last 7 years, no rehypothecation of client funds, no weird risky stuff going on behind the scenes, and kind of more high touch with clients, right? Like we talk to clients about what it is they're trying to do, or if they have some sort of view, they want to actualize with derivatives. Not everyone's a derivatives expert. So our traders will gladly kind of get on the phone and just talk about what it is they want to do and how to actualize that view in a sort of capital efficient way.
The thing that I caught when you said that was, you said, no blowups, which I know off screen you were tapping on wood, because I think besides baseball pitchers, the most paranoid and suspicious people are traders. Is, you said no rehypothecation. And we were talking, we mentioned the company, but there's rumor that some of these new services that are coming out in Bitcoin, people should be reading the terms of service, because when you say that, where can clients go to get the comfort that you don't have rehypothecation? Is that something that you guys provide in documents as well?
Or better yet,
to be honest, I'm not.
Sorry to interrupt. Can you just explain?
Sorry, go ahead.
Can you just explain rehypothecation within this space? I know you mentioned lending, and I think some of our listeners may just need to understand that term.
Sure. So rehypothecation is basically when you're holding client assets, which are really a liability to them from the perspective of your balance sheet, right? Like, if Bill deposits $1 billion in Bitcoin, that's a liability from us, right? Because we have to give that back whenever it is he wants to withdraw it. And rehypothecation essentially is just lending out of those assets, right? Because trade desks may, or even, for example, like Celsius, right? Their primary business wasn't being a trade desk, it was being a lender borrower. They would kind of re-lend margin, or the general process is really just re-lending assets that you're sitting on that kind of aren't yours to make, squeeze out a couple extra bips. And most of the time it's safe, except for when the markets hit these 1 in a million tail events, which aren't really 1 in a million, as we know. They happen far too frequently, especially in the crypto market. And everyone kind of starts, it can amplify that blow up risk, because it now is a systematic chain of blowups that can happen across multiple firms if they're all rehypothecating or lending to each other. So that's kind of what it is.
Yeah. Thanks for that. And it usually, as you said, it happens at the wrong time. Like how we were saying, when PM start asking for more leverage, and when you look at the blotter and the trades tend to be the same, whether it's long momentum, long vol, that's a long in the tooth trade. But following up on what Bill said about you guys and differentiating, I saw on your website you guys have that wheel of clients. If you last pod we were in Houston talking about co-locating Bitcoin miners in data centers to complement all that stuff. That was there. Can you explain your wheel about what clients are doing in order to require your services? Like, who are 3 or 4 the kind of client types that you have?
Sure. So I think the 3 kind of broad categories I could really chop it up into is 1, miners. We have miners, and I'll call them also institutional clients. So, that's kind of self-explanatory. There's always flow coming in from miners and other desks that may need to swap this coin into that coin. And we're also very hooked up in terms of fiat. Our banking is very robust behind the scenes. So we're able to perform lots of kind of on-ramp, off-ramp services there as well. The second I would say is kind of your like.
What does that mean? Sorry, Ben.
Sorry, go ahead. Yeah, Joe.
Fiat on-ramp for who?
So, for example, we may have a business that's not necessarily a crypto trading desk, but they're peripheral to crypto and they accept, crypto as payment, right?
Okay.
And maybe they need to send, I don't know, $10 million USDC to another entity, but it needs to end up basically as GBP. So we can perform that swap for them, right? Pretty seamlessly.
Got it.
And in a timely fashion. And that's kind of actually that's a big flow in the crypto markets in general, is really the payment infrastructure. So yeah.
Do you guys charge 3% like Apple does?
Oh, 3% definitely not. I think we'd go out of business. I wish. 300 bips sound nice.
Joking. Yeah, I mean, that's why people are doing it. That's good for you. So yes, keep going. I just wanted to dive into that one.
Sure. Yeah. Stop me anytime. Just interrupt, dive in. Happy to talk about anything more specifically. But yeah, and then the second client kind of is your high net worth individual or family fund. And that's where they're taking either more kind of proprietary views on the market, like maybe they're interested in some sort of upside structure that's more capital efficient than, let's say, just going all out, spot purchase, or yield generation. So, your covered calls and other structures relating to kind of farming yield out of the assets you're holding. And I'd say the third kind of player we have is other sort of funds, and not necessarily hedge funds, but sort of funds that are more on the, kind of buy side of things. So they'll go in and ask for all kinds of funky products, right? Like we've had guys ask for ETH BTC ratio options, weird stuff like that, taking risk reversals on the ETH BTC ratio. They're taking kind of the more bespoke sort of product.
So you'll structure that, or will you go in the marketplace and try to broker that transaction with someone else as like as a standalone contract?
Well, so we're always the principal in the trade, right? We're always facing the client, but sometimes it'll be a bit of both depending on our kind of views and positioning. We might just find it easier to back out most of the risk, or we might just kind of take a view against our own balance sheet and hedge it in some sort of other way. But yeah, I mean, there's all kinds of funky stuff like we can do, and happy to get into that if we talk about products.
And the bigger you get, the more optimization you can have. Like a a firm like Fidelity, before they trade any stock, it goes through their warehouse. So all the PMs, they all net against each other before they go out to the street. And you guys, same way, right? I mean, that's the yum of having your own place, is that as a clearinghouse of risk, you can cross things internally.
For sure.
Nice.
Yep.
Rates of change. I think May showed it with Bitcoin up, 12%. Ethereum had a big jump I think in May as well, right? I think May 8th or so, it shot up around there.
Yep, around there.
The ETH degens emerged from the graves. They were finally happy about something.
They awoke from the hangover.
And then, you know, I still think the Coinbase Deribit transaction is huge. The IPO of, what's the name of the TradFi digital hybrid? eToro. eToro had an IPO. Galaxy finally got theirs off the dime. So I think those were in the offing. Those were ready to go. Like eToro was years in the make, was at least 18 months in the making. Galaxy was, you know, dead on arrival for years. So those were just pent up demand. But the Coinbase Deribit, that was a decision, I think, by Armstrong to recognize the business you're in. Exactly what you said. I forgot how you termed your firm that was going to get you in trouble with the spot folks.
The full suite OTC does.
Right. That's the game, and it is just starting.
Yep.
So I think that's my opinion, Ben. But is there anything that you've seen on the client side, although your clients are probably already seasoned, that would indicate my suspicions that May was a inflection point? Or is that just...
Yeah. Well, first of all, actually, a lot of our clients, believe it or not, aren't going to be your 15, 20-year options traders, right? Even the bigger guys, there is a decent amount of education and kind of, you know, I don't, not really holding hands, but kind of a back and forth between our trade desk and them, right? We're helping them understand market environment versus pricing of these things, and you know, when you should hedge and stuff like that. But I think that the Deribit Coinbase thing is, first of all, it's incredible. I mean, I think Coinbase is an amazing product. I'm glad they made it onto the S&P. Don't like their UI. Don't kill me, please, Coinbase, if you're watching. But I don't really love the UI, but I think it's an incredible product. The fact that they bought Deribit is incredible. And I think that, you know, in terms of flows, we weren't necessarily seeing something super out of the ordinary, but there was definitely interest in kind of your long ETH, short Bitcoin based positions. That's where the flow looked like it was going. And I think the ETH BTC ratio has, you know, obviously it's at a bottom, right? So there's definitely a play there longer term in my mind.
Yeah, I think it drilled down to like definitely 1.6 handle. I don't think it hit 1.5, but it was, it was down
close.
There.
Yeah. So yeah, I mean, it was. Go ahead. Sorry.
Yeah. Sorry to interrupt. I think now we're seeing, you know, the market rally. Generally, I'm picking up on some FOMO with my, you know, TradFi friends looking into investing. So I imagine some of your customers would be, you know, the family office types. And I know we don't really want to talk too much about who your actual customers are, but are you finding a lot of like the family office, high net worth types to either have, you know, previous exposure to Bitcoin or other assets? Like, it seems like now that we're bringing up ETH versus Bitcoin, maybe that's becoming popular again. I guess, what kind of demand pickup have you seen from the long-term holders of Bitcoin and other assets for your products?
Yeah, so I would say there's kind of two categories of that in itself, right? We have the guys who are long, you know, long-term, as you said, and then we have the other kind of family funds who are looking to dip their toes in and want to start accumulating, right? But maybe missed the train. And for that, that's where this back and forth that I was referring to earlier starts, right? We talk to them about all kinds of accumulation strategies, like, hey, sell some puts, right? Let's structure this as a physically delivered option. Let's do some short put spreads. If you want to go a little bit more, you know, quote unquote complex, we have structured products like the accumulator, where it's basically like let's say a 10-week program with a strike price and a knockout, where you can essentially purchase ETH, for example, at this strike price, which is a discount to market, say 10 to 15%, depending on where vols are, on a weekly basis, right? Based on where ETH is. And, I don't want to talk specifically about this contract because I'm going to put everyone to sleep, but
Hold
my
on, Ben,
point is that
Ben, if you're
there
worried about
is,
if you're worried about putting people to sleep on this, first of all, the accumulator is an awesome label. Bill, do you know where I'm going with this?
yeah,
Your Terminator. Yeah, give Bill a couple specs, and we will generate through his process a graphic and marketing program for the accumulator who will be back. Like we can totally do an Arnold thing with this. I love that.
yeah, sure. Sure. And, I said complex in air quotes because I'm thinking from the math finance side of it. How do I hedge this thing? How do I replicate this thing? But in reality, if you talk to someone who wants to actually just accumulate the coin, this is the product you do, right? So here's an example, right? ETH's at right now, what, 26.25, right? So let's say we're going to enter a 10-week accumulator. Sorry, we also have a decumulator. Don't get me started on that one. Let's say it's 10 weeks long. We're going to call it 10 by 20. Those are the quantities, so just hold that for a second. And the strike price on this contract is 22.50, and there's one more price, the knockout price, which let's say is 3K, right? So this is how it works, right? So imagine now we're spot price right in the middle, knockout price is above at 3K, strike price is below at 22.50. Every week, we're going to look at where ETH is Friday morning, right? If ETH is anywhere above 22.50, the client can purchase 10 ETH at 22.50. So if we're trading at 2,700, client gets to purchase ETH at 22.50, 10 units. Next week, if the same thing happens, same thing, clients purchase ETH at 22.50, 10 units. Next week, if ETH goes below 22.50, now the client has to purchase double the amount. So 20 ETH. So what ends up happening basically is it's a play around the strike. At that fixed strike price of 22.50. So if you're basically between 22.50 and 3K anywhere, right? And remember, we started at 26. You get to buy ETH at 22.50. So for those who feel like you've missed out, you're basically getting a contract that starts you off with the ability to sequentially buy ETH at, call it a 10 to 20% discount. And this varies based on the term and if it's weekly or monthly. We can structure it in many different ways. And then it's like, you could say, well, if ETH is below 22.50, like at 21, I have to buy double. Well, great. You would do that anyway if you had limit buy orders, right? And this way you're getting a premiumless contract. And then the knockout thing is basically if ETH touches 3K at any point during this 10-week period, the contract just ceases to exist. It knocks out. But everything that happened prior already happened, right? So from a client's perspective, it's like if you're going to accumulate the coin, you really don't have many choices, right? It's like you go balls to the wall with spot. You maybe buy a little every week. Or you can do something like this where you kind of get the best of both, right? You get to buy at a fixed date at a discounted price. And, if it rallies too much, the ideal thing is it kind of rallies a little bit, right? And stays, because then you just keep raking in ETH at a huge discount.
Yeah.
So that's the product.
I haven't heard of that. I haven't been involved in options since my convert days, that into the complexities. Do you see people doing the simple thing? It's simple and may not be there because it's low probability. Just writing puts to accumulate that simple thing of just collecting premium and potentially buying your coin at a discount.
Yeah, absolutely. We have people doing that all the time. That's also, I think, a great strategy, right? It's like if you're selling, I don't know, even September, let's say Solana 120 puts, there's a decent amount of premium in there because SOL vols are pretty high. And if you annualize the premium you're earning, it's great depending on the strike. I've seen easily 50%, 40% annualized. That's really nothing impressive for crypto options. And then worst case scenario, you get to buy SOL at 120, right? So yeah, we see a bunch of short puts, short put spreads, things like that.
Got
Definitely.
it.
Cool. I don't want to bring up my fears about liquidity and in the wrong environment for especially the retail traders that may be taking on too much risk and stuff like that. But I did want to shift it a little bit to my space in the systematic investing. I know you said you have API access. Are you seeing a lot of like systematic traders, either more retail, family office types, or like institutions accessing this market, with algorithms?
Absolutely. I mean, most of the trading is algorithmic, I would say. I mean, even when I, strap on and hit the order books, I can see them, right? I mean, you could see how the order books and the tape move and react. And, there's a bunch of algorithms that range in sophistication. But I mean, you could see the TWAPs in actions. I mean, I personally ran, uncountable amounts of volume through pairs trader, spread trader algorithms. VWAP algorithms, then you have obviously your market makers, and you can see order books from different exchanges reacting to each other in real time. You have your simple R bots, your options R bots. So yeah, I think a ton of algorithmic activity in crypto.
Following on what Bill just said about the algorithms, I know a lot when you go VWAP, I know a lot of it in the traditional world hits in the last 20 minutes of trading. ETFs in traditional markets are anywhere from 20 to 30% of volumes, some days higher.
Mm-hmm.
And a lot of that's, on the open and close. So you have this sort of jammed period and a snoozer in the middle. How does that differ in a 24/7 market for you guys? Is like, how do you do a TWAP? Do you define the close of what? Like, do you?
Yeah. So you can define it in, various ways, complex and non-complex, but basically you could define it on the 5-minute TWAP. A lot of expiries for exchanges, whether it's like options or futures, are based on like a 30-minute or hourly TWAP. So there's a lot of algorithms replicating that, if you're an OTC desk or a market maker. But yeah, there's, as much as people like to say crypto is decoupled from equities or a hedge, I mean, there's clearly heightened activity at 9 a.m., 9:30, clearly 4 p.m., right? Clearly 6 o'clock, futures reopen. The daily candle close at 7, 8 p.m. New York time. So there are these concentrated points of activity. I mean, Asia open, London open. So you can see it. Yeah.
And is there a difference between, in your derivative space, are there folks who are creating contracts against spot away from exchanges? And then obviously options are going to be, not obviously, but doing some derivatives on listed items versus spot decentralized assets? Or are they always going to somehow be, as you just said, I think, influenced by the larger listed market?
Well,
actually,
I guess
not even larger, by the listed market, whether it be ETFs or options or futures.
Yeah, I mean, in our kind of space, OTC, you can get, physically delivered spot Bitcoin for your option expiry. You can have it cash settled in dollars. You can have it cash settled in coin. That's another very popular feature of the crypto options market, is that options are traded, settled, and margin is in the underlying rather than in cash.
Yeah.
So yes, to answer your question, there's a lot of that, and a lot of also customization and flexibility.
Got it. And how much of the trading, just stepping back in general, is an index? I know Bitcoin is like 60 odd % of the entire market cap, 2 trillion of 3.5 or so. On the trading, it's 50 billion or so, 40-50 billion. Is that on spot?
In terms of market cap?
In terms of spot trading volume?
Oh, spot trading volume? Oof. I mean, I would be pressed to say even more, honestly. Um, I think Coinbase alone was doing, clearing $1 billion in spot Bitcoin volume,
And they're only
right?
like
So,
10% of the market. Yeah. So
yeah. And then, you factor in all these other places.
So what we got people all over the map on this call. We have, besides family and friends, so thank you folks for joining. We have some traditional, mostly traditional, and then we have some degens on. So for those, I know
Nice.
2 pension folks are dipping their toe in, who we've spoken to recently. What would you tell them to look at as far as resources either your firm has or that has helped you understand the growing ecosystem? Or is it just basically you've got to focus on a very narrow area and grow from there? So I'm asking for some adoption tools.
So adoption, like using the use of Bitcoin or how to actually make money in the crypto market?
I would say tools so that people can then bring it on their desktop and start watching things like the ETH BTC ratio, maybe hash rate,
Gotcha.
things like that.
Getting into I gotcha, where you get your, how do you dip your foot into crypto, so to speak?
Yeah.
It's easy. I think the first thing is if you ever want to look at charts, I go to TradingView. You don't need an account that's paid. You can get a free account. You can pull up, obviously equities, futures, blah, 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 but also crypto and crypto from different exchanges. You can look at Bitcoin spot on Binance. You can look at Bitcoin spot on Coinbase. You can look at the BTC ratio on Coinbase. So I would go for TradingView if you want to look at chart stuff. But for access, I think Coinbase is probably the way to go for US clients. I mean, unless you're going the OTC route, I'd say secure digital markets for sure. CFTC compliant, facing US clients. So if you go OTC, there are paths to do that. But I think for ease of access, Coinbase is where you start, right? You got a wallet for any of the coins you may want to send back and forth. And if you want to look at data, on-chain data, you can look at the block, right? And there's also other resources,
Block's
all
really
over.
good.
You just type in
Yep.
yeah, Block's great. And they have all kinds of, very different panels of data that you can look at.
Good. Thanks for that. I think, Bill, I don't know if you have kept track, but I think that's a record. I think 45 minutes before someone mentioned their own firm. As a resource, we love the humility and the general spread of knowledge that you're doing here, Ben.
Well, hopefully people saw his T-shirt as well, which has a nice logo on it. Was
silently telling us subliminally what's going on.
I think it might be time for that shameless plug. But yeah, no, I think folks should also definitely check out SEM. I think our services, ranging from spot lending derivatives all the way to the client outreach aspect of it are fantastic. I don't see many competitors in that side of the house. And I think also the ability to talk to traders and ask them, what are you seeing here? Like, how do I make money in this kind of market moment? The answer isn't just buy coin X, right? You don't need a trade desk to do that. You can go on Coinbase and buy Farcoin, right? It's understanding there's a basis trade, right? Like yields right now for against, the carry trade with futures and spot are 12% annualized. Well, the regular person's not even going to know what that means, but you come to someone at SDM, we walk you through that trade and we explain to you literally step by step the operational process, how this is going to go and how, your million is going to become 1,012,000, right? In whatever amount of time. Or selling covered calls, right? Most people wouldn't even know that you can earn upwards of 20, 30% annualized just by selling calls on some of the crypto they're already holding.
Yeah.
Hedging some of their high volatility, crypto assets like XRP or like, SUI. So I think everyone should definitely go and check out, SDM and get in contact with someone from our company. We're very open.
Yep.
And how would we get in touch with SDM and you? Like, do you suggest people follow you, reach out to you?
Yeah, I mean, you can always follow me on LinkedIn. SDM does have a website. I believe it's sdm.co. I can confirm that, but yeah, we have a website. I mean, you can always email someone from our team. Like myself, my email is pretty simple, Benjamin@Secure Digital Markets, right? And it's really, if you just go on the website, right, and you'll be able to get in touch with somebody pretty quickly. I mean, either on the phone or via email, and from there, it's very easy to just get on a meet and talk shop.
That's awesome. That's almost too easy. And following up on my systematic questions, I was going to also ask about getting leverage and short exposure in particular. Outside of, you mentioned Coinbase, you can short futures there, and I think programmatically access that. But when you mentioned decumulator or more of these structured OTC products, those seem like they could be really cool to work into a systematic strategy. And I think you were already rattling a lot of them off, but I think I would love to get more of a deep dive sort of view on that. And for example, decumulator did just make me think, okay, I want to get some short exposure that may have a little less volatility, and I'm not sure what margin requirements are with these types of things, but I guess that's a very open-ended question. But do you find sort of newcomers to the OTC market trying to figure out how to incorporate these types of things into a more, I'm a factor investing expert in equities, but I want to get into crypto. Do you find anyone seeking, in particular, I'm thinking short exposure and leverage, but just replication of the TradFi systematic strategies with your products?
I would say not in the classical sense of oh, this guy's doing the long short equity and this guy's doing but some of it, yeah, like pairs trading. We see a lot of that. I mean, this is a great market to do pairs trading in because the ability to short is very easy, right? For example, we can do an NDF, a non-deliverable forward, where you get short exposure in the form of forward, which is basically a futures contract, right? We see a lot of that, and you can, going the options route, selling calls, right? So if you're doing this accumulator, you get to basically buy ETH at a discount. I was actually thinking about this, like, what are some systematic strategies you could do? Well, systematically selling short dated calls, right, to boost returns even more and kind of play this range that's happening. But just to answer, your question about access to shorting, for whatever the strategy might be, it's very simple, right? I mean, the international folks have access to perps and futures. And for our American folks, we have NDFs. And the margin typically is about 30%. Depends on the instrument, but I'd say 30%, so you're getting roughly 3x leverage there.
Mm-hmm.
Cool. Sounds
but yeah, no,
good.
we've had guys just to add on to that, do long SOL short ETH futures, right? Or NDFs rather, for, I think it was 3 months or 6 months at the time.
Mm-hmm.
Basically playing the SOL outperformance trade, but not having to deal with how do I short spot, right? How do I borrow? Right? Just do it synthetically with the NDFs.
Yep.
Yeah, NDF I think is the answer that we would have looked for, because I think a lot of people understand the basis trade when it's like the same coin, but pairs trading I think is a little bit more difficult when you're on Coinbase trading a spot Bitcoin versus ETH future, it's a different basis, and I'm not sure how that kind of works, but cool. I think we're coming up on about 50 minutes as well, so I want to make sure we continue to plug secure digital markets as our first crypto institutional guest, and we obviously appreciate you joining us today, but I think our listeners who are from the TradFi side and learning about this space in particular probably really enjoyed getting the inside view of how it works.
Yeah. And I mean, I'm happy that you guys invited me. Always happy to talk markets, talk shop, and do stuff like this. And educating is one thing I also love doing in this market.
Yeah, and just for the folks out there, obviously the part about SDM that Ben spoke about is you can call someone, and if you have some business to do in especially OTC and options, we suggest you talk to someone who's been in the space for a while. I know that there are a lot of folks, my friends, who do covered call writing on their equity portfolio. Been doing it for years. Love it, love it, love it. And all of a sudden, either they get taken out and it runs, they're not that happy, or market dumps, and they got to restrike higher, but their principal's down. Blah blah blah. When I showed them what the premiums were like in our space, on the more liquid Bitcoin, they went running in.
It's crazy.
It's something to consider, and I still think, Ben, I don't know, Bill, you've talked to some folks as well. And at Bitcoin conference, some of the institutional guys said there are still so many institutions who are not looking at it, who haven't spent the time to understand the opportunity in the, I would say, risk-constrained space of options, the rich, full surfaces, and not all of them are normally distributed. They're skewed. There's so many neat opportunities that are still there to be harvested. So yeah, that's why we want to have you guys here, because we know where you're going as a firm. So look forward to having you guys on again.
Appreciate it. Thanks, guys.
And we also appreciated you giving us your email, like basically on air. So we will put some of Ben's contact details in the show notes too, if you want to reach out to him. And
spam it.
Okay, feel free to spam him and reach out on LinkedIn, and hopefully we'll help build the network a little bit.
Excellent.
Yeah, awesome.
Well, thanks, great. Ben.
Thanks a lot.
Thanks for your time,
We will
guys.
see you on the other side. Take care.
Yep.